So what I did is I pulled this up in like teacher mode, which means it already has answers put in, because I think it might be more valuable for us just to kind of walk through it than to try to have me work it all out. Excuse me. I didn't want to sneeze right in your ear, so I covered, but then I grabbed the microphone, so it may have been just as bad. Anyway, so here we have this travel agency and a bunch of transactions for them. And this is like a brand new company, right? So they're starting with an investment by the owners, and then they give you a chart of accounts, and then they give you all this information you're going to need to do adjusting entries, and then they tell you all of this is required, and then they kind of step back and just watch you and see if see if they can watch you flounder. Like, thanks, McGraw-Hill, that was very kind of you, right? So so the process, of course, is to just start to go through this thing piece by piece. And so first is to do all these journal entries. Does everybody feel like they understood that pretty much, like the journal entries, or is that something that we should talk through a little? Because that's kind of review stuff we did in previous chapters, right? All right. So then, so that's the first requirement: prepare the journal entries. And again, I mean, it's just walking through those journal entries. And then the second, let's see, the company records prepaid. Okay, so so requirement 3 is they want us to use the account balances to prepare an adjusted trial or unadjusted trial balance. So again, once we have all of this info, because it was a brand new company, they didn't have balances in any of the accounts. So we can just go through and we can tally them up, right? We can say cash was debited 30,000, credited 1,800, credited 1,000, and we can figure out the balance of the cash account. And we can do that for each account. So then we end up with this unadjusted trial balance that has a balance to cash and each account thereafter. What I don't like about the setup of this one is like accounts receivable here has no balance in it. And in real life, trial balances, just if an account doesn't have a balance, they usually just don't exist. They just don't show up on the trial balance. So that could be a little confusing. Like, I think like half the time the problem with these are like, I kind of know the concept and how to do it, but I don't know what they want from me. Do they want me to include that line or not include that line? And I mean, that's frustrating. But at the same time, it's better than, when I started teaching, where you would have to do this by hand on a piece of paper and wait a week for me to get feedback back to you. At least there's more immediate feedback, which helps. But I'm feeling your pain, I guess is what I'm saying. So after we do, again, stop me and ask questions if somewhere along the way you're like, yeah, you're glossing through this, but this is where I need help. The 4 is to journalize the adjusting entries for the month. So here we have to look at each of these. So we say, okay, prepaid insurance of $133 has expired this month. So I just learned in Mr. Fox's incredibly gifted lecture that prepaid insurance and adjusting entries are always going to be a debit to expense and a credit to the asset. So this one says $133 expired, so I'm going to debit insurance expense, credit prepaid insurance at the end of the month. But this one's a little tricky. This one says at the end of the month, $600 in office supplies are still available. So that leaves me to have to look back at the trial balance and say, okay, there was $1,000 worth of office supplies. If 600 are still available, then I must have used up 400 during the month. So then my journal entry is to debit the supplies expense, credit the asset office supplies by $400, thereby leaving the new balance of that account at 600. Those can be more confusing. On this first one, they gave us the amount. Here we had to calculate it. C, the month's depreciation on the company's equipment is 500. Well, that's nice of them. They're just telling us how much. So again, we debit depreciation expense, credit accumulated depreciation. D, the employees earned 420 of unpaid, unrecorded salaries. So again, we're accruing this expense, recognizing we've earned it, or incurred it. So we debit it 420, and then that we haven't paid it yet. So we're going to credit the salaries payable in the next month. We'll pay it. Finally, the company earns $1,750 of commissions that they've not yet billed. So we're going to record that as an accrued revenue, which means we're going to debit the asset accounts receivable and credit the revenue account. So there's our adjusting entries. Once we've done this, so here we already had our unadjusted trial balance. We've made changes to these accounts, and so we're going to have to account for those in the adjusted trial balance. And that's just going to have the balances of each of these accounts with the adjustments figured in. Then 5A, we're going to take this info and we're going to create an income statement. So we can look on here and say an income statement has revenues and expenses. So here's my revenue account. Here's my expense accounts. And those amounts carry forward here to the income statement. Then we're going to do our statement of retained earnings, which is going to have our beginning retained earnings, which was 0 because it's a new company, plus any net income, which we calculated right here, minus any dividends, which we're going to have to go back to the trial balance for. And that will give, and then that will let us calculate the retained earnings at the end of the period. Then we're going to do our balance sheet, which is going to be our assets, which again are right on the trial balance, our liabilities on the trial balance, and our equity. Common stock was on the trial balance, but the retained earnings we calculated back here in our statement of retained earnings. Next, we prepare the journal entries to close the temporary accounts. So first we close our revenue by debiting revenue, crediting income summary. Then we close our expenses by crediting the expenses and debiting income summary. Then we're going to have some balance since we credited 9750 and debited 7553. We know that income summary will have a credit balance of 2,197. So we close that by debiting income summary, crediting retained earnings, and then we close our retained earnings by debiting retained earnings and crediting, and crediting dividends. I say close retained earnings, we're closing dividends by debiting retained earnings and crediting dividends. So again, this is a fast run through. Don't be afraid to ask a question. And then this general ledger part, I noticed several people asking questions, like this one freaked everybody out. But really all this is like a running T account, okay? So we go back to these entries we made all the way back in the first one. And we say, okay, I debited cash 30,000 on April 1st. I debited computer equipment 20,000. I credited common stock 50,000. So I come back over here. I record the debit on April 1st of 30,000 there. The debit on April 1st to computer equipment here of 20,000, and the credit to common stock somewhere. Where is it? There it is, of 50,000 on that same day. Honestly, the easiest way to do this is to come back to these entries, take a picture of it with your phone camera or something like that, and then you'll have all of these entries over here. And then all you're doing is you're just recording each entry by day and giving the balance at that time. Finally, you do a post-closing trial balance, which is just going to have the balances of each of these accounts. So cash will be 27,000 on the debit side. Again, I'd probably take a picture of these and then come over here and do cash 27,000, account receivable, and so forth. And hopefully it all balances.